Before now, let's turn our attention to personal finance segment. Yesterday, a conversation with Harshvardhan Roongta got cut short on account of some news with respect to the election, but we go back to him again with the same question about insurance. Harsh, if being underinsured is a problem, so is being overinsured. So what are the complications that an investor might face due to this, and how can an investor decide what is the optimum insurance cover for them?
Well, it's true, as we mentioned, that overinsurance is also a concern if underinsurance is one. So, let's understand the purpose of insurance in the first place. It's basically to replace a person financially for his dependents. The idea is not to profit out of it. Now, I use the example which I just shared yesterday as well. See, if a 30-year-old person earns about a lakh of rupees per annum and he's got about 30 years of working life ahead of him, so we ascertain the economic value to be about a 30 lakh of rupees. So that's just 1 lakh into the next number of years remaining for retirement. Now, obviously the next year's income is going to rise, but the number of years remaining for retirement will also reduce proportionately. So the idea is that a maximum cover a person should take is this figure, which is the income that he's generating today into the number of years he's going to be working henceforth. Now, because term insurance premiums are very cheap, he could get a 1 crore cover for as little as 12,000 rupees a year. So he goes ahead and buys a cover of 1 crore, suppose for instance. Now, his value dead is more than his value alive. His family has in disposal to themselves about 1 crore of rupees as against 30 lakhs which he would be generating otherwise. Now, this situation leads to a couple of negatives. Now, first is, there is a moral hazard in this kind of a situation. If it is more beneficial for this person to die than what he's going to be alive, there could be instances of crime such as murder, to take the benefits of the insurance proceeds. We're not talking about any individual case, but we're talking in general. This could lead to a situation like this. And insurance-related crimes are a known phenomena world over. Look at the other side. If, after a couple of years, a person is under undue financial distress and he may probably feel and he will want to commit suicide because he feels that his family will benefit out of the insurance proceeds, which he will not otherwise be able to manage himself. And suicides are paid for in insurance policies after 1 year waiting period. The other impact that could likely happen is that all individuals have limited resources. We need to allocate them for all our personal finance needs. Insurance is just one area of personal finance. There are medical insurances which are required. There is disability insurance which is required. You need to make provisions for your retirement, for holidays, kids' education. There are lots of these. So in case you're buying more insurance than what you require, you're certainly paying more premium also than what you otherwise would be paying. So you need to balance out all these and take adequate cover in each and not overshoot your limits in any one area itself. Regarding your question as to what is the optimum level of cover that one should have, now that's a good question. There are lots of methods in which a person can determine how much cover he should have. For layman understanding purposes, I would say that one option is that he looks at his annual income. He takes an insurance which is 12 to 15 times of that. And say for example, a person earns 10 lakh rupees every year. He buys an insurance of up to 1.5 crores. And adds another amount which is equivalent to his liability. Suppose he has a housing loan outstanding of about 50 lakhs. So he then in that case goes in for a cover of 2 crores of rupees at one shot. Or he looks at another method which is an expense replacement method. He ascertains that he needs to provide a particular amount every month to his family. Say for instance 50,000 rupees every month. And the post-tax returns available is about 6%. So if he has an insurance of 1 crore, his family can deposit that into put it into a bank, which post-tax returns would be say 6%, so which is 50,000 rupees a month. So these are the two basic methods a layman can use and determine how much is the maximum cover he should own. So that is, and so basically he will protect himself from overinsurance.
All right.